Welcome to the Professional Edge. My name's Sean Todd, tax attorney, CPA, and certified financial planner. We're talking about you as a listener being paralyzed financially on what decisions you need to make going forward. We have the Fed going to meet here the next week, beginning of November. Almost for sure going to raise interest rates another 75 basis points. That'll be the third rate in a row. And then we also have the Fed unwinding their balance sheet. What does that mean for our listener here on the Professional Edge? Well, they acquired a whole bunch of assets to their balance sheet during COVID and during the economic downturn there, and we have pumped a lot of money in the money supply. So that has triggered inflation. When there's more dollars chasing a limited supply of goods, we have inflation. So the Fed's barometer, or they say inflation is way ahead of itself. It's at a 40-year high. We feel it in food, we feel it in our energy prices, and we felt it in building materials. So now the Fed says we're going to raise interest rates. So that's going to dampen demand. Well, it's not taken hold yet, and you got to remember that when the Fed does these interest rate changes, immediately in the market, it is reflected, but the overall impact is felt 6 to 9 months down the road. Well, if we have this third 75 basis point, then look about 6 to 9 months down the road. So that means the mid of 2023 is where the real impact of these interest rates are going to take hold. Not today, not tomorrow. It is 6 to 9 months down the road. We've seen a 30-year mortgage jump above 7%, highest in 20 years. Think back to the Carter era. I mean, we were at a 16, 17% interest rate on a mortgage. We were elated to get 11 or 12% mortgage rate. Well, before the interest rate climb, you could get a 30-year mortgage for under 3%. Now it's above 7% and going higher. So the cost of carrying a mortgage is more than doubled. So that is going to temper and slow down housing. So you as a listener here on the Professional Edge, being paralyzed financially, where do we need to go with our portfolio? You're thinking about retiring in, let's say, 3 to 5 years. Or you thought you were going to retire in 2023. Well, going back to the return risk, the sequence of return risk, you're in the downturn of this cycle. And yes, we've had a recent bump, but Amazon announced that they anticipate slower than normal sales coming Christmas time. Well, wow. They got pounded, and as the news outlet says, Amazon stock plunges. So those are adjectives that we need to be aware of. So again, we see headlines like that, CNBC touts gloom and doom. So it's only reasonable that you would be paralyzed financially. Do I buy bonds? Do I sell bonds? Do I buy equities? Do I buy technology? Facebook has erased, $200 billion of market cap, or, Mark Zuckerberg, his net worth has dropped by, billions, tens of billions of dollars. And that's just one company that's there. We also see that NVIDIA, the chip maker, they've been hurt, but we're not getting away from using technology. So you scratch your head and say, where do I need to go? What do I need to do? And you just don't know. So therefore, you're paralyzed financially of making any decision. Well, making no decision is actually making a decision. So what you do is get an objective opinion from a third party. And that's where we offer our listeners here on the Professional Edge that opportunity to sit down, see what you need to do. And to schedule that, give our office a call at 877-654-9798. That number again, 877-654-9798. We can meet virtually via Zoom, or we can have a very candid conversation sitting here at the Cunningham Center or in Atlanta. If you want to see the new construction up here at 400 and 285, it is a massive nightmare when they shut down 3 lanes on an interstate that are 5 lanes wide. It is traffic jam 101. So if you're feeling that paralyzed on, you don't really know what to do, you had a 60-40 mix, 60% equities, 40% bonds, in your portfolio, that safe asset class, those bonds have actually declined in value. A 10-year has dropped greater than 10%. Think about that for a second. Bonds are supposed to be safe, and they dropped greater than 10%. You add that to your equities, and the NASDAQ dropped over 30%. You just start scratching your head saying, well, I give up. I toss my cards in. I fold. Well, don't do that. Do give our office a call at 877-654-9798. That number again, 877-654-9798, and we see what we can do. If we can capture some tax losses, go ahead and recognize those, reallocate that portfolio. And if we can reduce your bond duration, go ahead and do that. Move those around. And now you have a tax asset that you can write off against other income, your ordinary income, your W-2 income. You also have that capital loss to offset future capital gains distributions. So it's not all bad things. We're going to make some lemonade out of lemons and move forward with that. So again, being paralyzed financially, you might want to take a look at our website that we put up just for you as a listener here on the Professional Edge. And that website is capitalatrisk.com. That is capitalatrisk.com. And it gives you some great information. We're all sort of stymied on what's going on, but there are some good sectors to be in. And we evaluate that. And for example, like preferred stocks right now are yielding almost 7.5%. Are we going to buy an individual issue? The answer is no. We like diversification. So therefore, we would buy a fund of preferred stocks and get that yield while things are sort of going forward, figuring out whether the Fed's going to stop at another 75 basis point. And we're learning of companies now cutting overhead because they're not reaching their earnings per share number each quarter. So the easiest and quickest way is to reduce the labor force. So we're hearing announcements of cutbacks, and those individuals, fortunately, in this tight job market, unemployment being less than 4%, they're going to be able to find a new position and jettison over. So I'm not sure that this is going to be the same economic slowdown where we have a lot of unemployed individuals, not until that absorption is done and the individuals that have been laid off reposition themselves into these opportunities that have been open for a while. Because a lot of people are saying, hey, I'm not going back into the office, and if you force me to go back into the office, I'm not going to come back. So those individuals are given the opportunity to find new employment. Well, at an unemployment level of less than 4%, that's greater than fully employed, at least according to the economics. So therefore, those people are going to be able to be absorbed into that. So do not look for unemployment to go up to 8, 9, 10% like it was in past recessions. Yes. Is there going to be an economic slowdown? The answer is yes. We still have the conflict in Ukraine that's there, and Soviet Union, or being Russia, it sort of dates me on the USSR. Russia is going forward with their plan to acquire even more space in Ukraine. So that's having an impact as well. And then also Saudi Arabia said we're not going to increase the amount of oil we're pumping per day. So the president has released some of these strategic reserves. Not going to go into politics, but in order to keep the supply then and not have the price of gas go to $5 a gallon, then some of those strategic reserves are being released into the marketplace. So therefore, gas is moderated back to like $3.14 a gallon, still higher than what it was 5 years ago for sure. So we have to determine what we need to do and move forward. Yes, there are certain things that we can control as a listener here on the Professional Edge. One thing we can do is visit capitalatrisk.com. That is capitalatrisk.com. And see what we need to do there. We talked about one position to be in is a CD. Yes, the rates on CDs have increased dramatically during this rising rate environment. So it might be okay to lock in a little bit of money. I would temper you and wait until the Fed announces what they're going to do in November before locking that in. That's one. Number two, then we can also look at a guaranteed annuity. That's going to protect our principal based on the claims paying ability of that insurance company. One that we've come across is 4.9% guaranteed for 5 years. So they can't change that, modify it. It is a contract of 4.9% guaranteed for 5 years. You need access to the money, then you can withdraw 10% tax, or not tax free, but penalty free from that contract. So if you had $100,000, you could get 10% of that. That's 10 grand. So if something unfortunate happens, you can access those funds for that 10% free withdrawal each year annually. So that's not a bad proposition either. The other one, which we talked about, is an equity index annuity. Again, your account value, that $100,000 in our example, is not in the market, but it's based on a credit on an index. And a lot of people are familiar with the S&P 500 index. So the insurance company says, we're going to give you 100% participation up to 8.5%. And anything over that, you don't get. So if the S&P 500 1 year anniversary from when you take this out goes up 12%, well, they're going to give you 100% up to 8.5%, and therefore you would not get the 12 or 14% the S&P actually did, but you would get the full 8.5%. That would get credited to your account and be locked in. So now your principal of $108,500 is not subject to market risk. So you only participate when the market goes up, not when it goes down. Now, prior, these contracts weren't really fair, in our opinion, to the individual, and that's why we sort of stopped recommending them. But with the change in the treasury rates, the contracts have changed based on the insurance company rewriting their underwriting, and now they're allowed, or they are now offering these provisions, and this is not a bad one, in my opinion. You can get up to 8.5%. It's a 5-year agreement. Not a bad proposition. Some go 7 years, 9 years, 10 years. Some go as long as 14 years. I don't agree with those in most opinions. So therefore, if this is of interest to you, you want to lock in your principal, get some of that out of the market risk, and then participate 100% up to 8.5%, do give our office a call at 877-654-9798. That number again, 877-654-9798. Just like vehicles that are not all made the same, so you got to make sure what you understand before you place your capital into that. And again, I appreciate you listening in here on the Professional Edge. We have a lot of things in front of us, and being paralyzed financially is not a plan. You need to figure out what you need to do and take advantage of what you can in this environment. And I appreciate you listening here on the Professional Edge. My name's Sean Todd, tax attorney, CPA, certified financial planner. If you want to have an individual personal consultation, do give our office a call at 877-654-9798. That number again, 877-654-9798. And I appreciate you sharing this with other individuals. You can always listen to us on the podcast underneath your podcast providers, being Apple, Amazon, and all you need to do is queue up Professional Edge, and we're there.
With today's financial markets, are you getting the personal and professional attention you and your money deserve? Clients of estate management counselors benefit from having one set of professionals advise them on their tax, estate planning, and investment advice. We call that the Professional Edge. Sean Todd is a tax attorney, CPA, and certified financial planner. With over 15 years' experience, he welcomes the opportunity to assist you in preparing for retirement, implement effective tax planning strategies, and to help you properly plan your estate. His radio show, The Professional Edge, is aired weekly on Sundays at 9 a.m. If you're interested in meeting with Sean, call his office at 877-654-9798. That's 877-654-9798. Do you want to feel more confident about making the right investment, tax, and estate planning decisions? Today, these decisions are more complex than ever. Have you thought about working with a professional advisor and not sure who to turn to? Not sure what qualifies one to be an advisor? Sean Todd is more than qualified as a tax attorney, CPA, and certified financial planner. Scene is with Estate Management Counselors. Estate Management Counselors operates as an independent fee-only investment advisory firm. They're dedicated to gaining a personal understanding of their clients' objectives and implementing professional counsel and advice to achieve those objectives. So take a second to talk with Scene Todd to learn how you can benefit from their multidisciplinary practice where they coordinate their clients' legal, tax, and investment strategies into one comprehensive and integrated plan to enhance and protect their clients' financial security. You can reach Estate Management Counselors and speak with Scene Todd by calling 1-877-654-9798. That's 1-877-654-9798.